Hi, and welcome to this week's look at the major news stories that have impacted the market so far and look likely to continue to do so. And we're going to start with the US dollar, and we saw a fall in the value of the US dollar as the Fed increased the interest rate. So the interest rate was put up to 5.5%, that's the 11th increase. Not really a huge surprise. There had been talk earlier in the month about perhaps it was going to be skipped this month, but it was fairly clear. But why did the dollar fall then? Well, it seems as though market participants are beginning to think that this potentially could be the last interest rate hike. It flies in the face of what Jerome Powell actually had to say, where he admitted there was a possibility of a further hike in September. But it's also the Fed is no longer considering a recession scenario. That's pretty good news, obviously, in terms of the overall economy. Not necessarily great for the dollar and thus further interest rate increases. And cash, therefore, not seen quite as relevant as a defensive asset. Now, Reuters analysts are also claiming that Powell's tone has changed and is certainly more dovish than it has been previously. Thus, we saw the euro-dollar rate rise by 0.75% from the low of the week. But where will the support be located for that? Well, look around the 50% level of between the growth A to B that you can see on the chart. The median line of the ascending channel shown in blue, also hopeful for a little bit of support located there. And if we look sort of at historical prices, well, a level of 1.02 worked as resistance just back in June of this year. At the same time, the nearest resistance is around 1.11, which was support just last week. It's worth paying attention to the rate of the decline in the price on the 20th and 24th. But now really the question is, will the bears break through the support block? Will the bulls use it as support for a further push up within that ascending channel? Worth noting, of course, ECB decision due out Thursday afternoon. No doubt that will have an impact as well. So keep your eyes and ears glued to the market news as it comes out. Okay, we're going to stick with currencies and we're going to take a look at the Great British Pound, particularly in relation to the euro and the US dollar. The pound's had a pretty good run of it lately with some pretty strong increases since the start of July. But we did see a slight change that very end of last week and into the start of this week. And it's fair to say the UK press has jumped all over it with some pretty sensationalist language being used, with one broadcaster saying it's the worst run since March 2020. I think it's worth keeping things in perspective there, really. A lot of people saying the dip is due to the Bank of England maybe not going as high in terms of its highest interest rate this year as was previously thought. Obviously, we had a rate increase just recently. We're expecting another one at the start of August. They're looking at that end level, that target level now being lower than we previously felt. Moving forwards, well, let's say keeping things in perspective, a fall to 1.15 against the euro was pretty short-lived and nothing particularly major. In fact, if we remember not that long ago, just early this year, February, March, April time, the rate was between 1.12 and 1.14. Now, in terms of the pound against the dollar, despite a 5-day decline in that price, the pound's still pretty buoyant, around the 1.29.6 just a little bit earlier Thursday. Now, obviously, interest rates are still in play and they can have quite a big impact. But if we perhaps take a slightly longer-term view, a longer-term look, try and iron out some of the initial volatility caused by rate rises, there seems to be a stronger feeling in terms of sentiment for the pound now than we've seen over the last probably 18 months to 2 years. Numerous analysts and commentators are expressing optimism for the performance of the pound, for the rest of this year and into next year. You look at Tier 1 FX interbank dealers, we're seeing quite a few forecast rates of 135 for sterling against the US dollar by the end of this year, and even up to 140 by the end of 2024. So cautious optimism may be the way to describe it as best, but do not forget there are a myriad of factors in play here. And I think we probably will see quite a bit of volatility as we move through the next few months. So don't forget your risk management techniques. Okay, commodity time, and like last week, actually, we're gonna look at crude oil again, and the price of Brent crude has reached quite a key level of resistance. As we mentioned before, the price is up 10% since the beginning of the month, and it could be the best month since June 2022 in terms of price increases. Monday saw the price exceed $82 for the first time since April of this year. Well, why? As always, why? Well, production cuts by Saudi Arabia definitely coming into play. Export restrictions from Russia, of course. China, we're talking about expected market stimulus over there. We mentioned it last week. They say they're looking to, prop their growth up a little bit further. Chinese demand equals more demand for oil, obviously. And we're having to the summer period, of course, and there normally, or often I should say, is a little uplift in terms of demand for gasoline and aviation fuel, particularly from large markets such as the US. However, technical analysis may suggest that this rally will slow down quite quickly. The price of Brent on the daily chart has reached the 100-day moving average level, which may well encourage shorts. A lot of people use moving averages for exactly that purpose. The price has also reached the upper limit of the channel shown in red on the chart. And it's worth noting as well that US inventories fell less last week than they were expected to. So all of these coming into play. We saw 3-week highs on Tuesday of this week. So that again, based on the information we've got coming through, not a huge surprise. But both Brent and WTI fell by over $1 on Wednesday. So nothing set in stone, as there never is in financial markets, but certainly oil coming back to the forefront for a lot of commodity traders at the moment. Okay, finally, we're going to take a look at a share, and of course it is reporting season in the States, and we're going to take a look at one of the best known shares, and that's Meta. And Meta's stock was up 7% after their latest report. Second quarter results have impressed, no doubt about that. I think ad revenue has surged, the company clearly embracing AI, and that's something we've touched upon before, how AI is a major driver now for the value of tech stocks, and their monetization of Instagram and Reels. Now, Facebook now has, they say, over 2.06 billion daily active users. That's an increase of 5% year on year. Now, if you add in Instagram and some of their other apps, for example, that goes up to a figure of 3.07 billion active users per day, an overall increase of more than 7%. At the same time, the number of employees has fallen by 14%. They've embarked on a cutting exercise. And in fact, Mark Zuckerberg himself said the austerity program will run until 2024. So increase in ad revenues, increase in daily users, decrease in costs. We can see why the report was taken favourably. Quick look at the chart. Now that shows Thursday should see an update to the high of the year. Both post and pre-market trade looking pretty strong for Meta. And the sharp momentum could enable the bulls to get a very, very strong foothold above the psychological level of $300 per share. And we've got a level of support at 290. So that's looking like that may well be achieved today. On the other side, let's have a look for some possible resistance. We have the $350 psychological level, which is approximately around the 2022 high. That could well come into play based on the activity we're seeing in the market. Further possible support, well, the median and lower limit of the active ascending channel that we can see in the chart could well come into play here. And the $305 per share level had an impact on the price back at the end of June, start of July. So that's also worth keeping your eyes on. The Wall Street Journal states that the average target price across a wide survey of analysts is approximately $330 per share. Well, that's clearly in sight at the moment. So we could well see a change to that average target price coming up very shortly, particularly off the back of the second quarter report, where the results are strong, and if that strength is perceived to continue moving down through the next couple of quarters. So we could well see that target price increase as well. Well, we wish you luck for your week of trading ahead, and we'll see you soon. Bye for now.